Welcome back, guys. I am Joshua Engel, and here are the 4 investing accounts you're going to need for the rest of your life. Doesn't matter if you're a beginner or you're a pro at this, these are the 4 accounts, and you won't need to change this as long as you set it up right. So that's why I'm here to help you. I'm going to tell you which companies you choose for each account, what investments or assets you should put in each, and how to use them properly over your lifetime. Doesn't matter if you're 18 or you're 50 years old, this video is for you. I'm not going to gatekeep, the timestamps are down below, but we're going to get off with the top 4. Roth IRA, high yield savings account, taxable brokerage, and 401k. And there's a secret 5th one, which is the HSA, which I'll get into after the video. So let's get into it. The first one, Roth IRA. What you need to know about it: it's a non-taxable brokerage tax advantage account. You can put in $7,000 a year maximum. It has income limit. It's so powerful that the government has to put an income limit on so people don't take advantage of it. $150,000 if you're by yourself, and $245,000 if you're married jointly, not separately, okay guys? And it doesn't matter if you're over that, because you can get around it. All you need is a CPA or your own tax guy, and they can help you get around it by using a regular IRA and rolling it over into a Roth IRA through what we call a backdoor IRA, but that's a topic for another video. Roth IRA, one of my favorite accounts. There's Roth IRAs and there's taxable accounts. What is the difference? Roth IRA, it's pre-taxed income. It's post-tax income into a Roth IRA, while a regular brokerage account is not taxed before. You get taxed after. So when you put money in a Roth IRA, you don't get taxed on it. So what are the best investments for this? So of course, you know, there's 2 assets that I love: stocks and ETFs. So contrary to popular belief, the Roth IRA is actually the best for single stocks. Why? Well, we can get into it in a bit, but if you're an ETF or a buy and hold investor and you don't know what you're doing in the beginning, there's 2 ETFs you should probably be putting into your Roth IRA. The one, S&P 500, and 2, a growth ETF, as long as you're young. But if you're older, then 1, S&P 500 baseline, and 2, a dividend ETF. So, of course, but why do I say that stocks are probably the best for this portfolio? For my portfolio and my Roth, I hold single stocks in a type of a growth ETF because I'm collecting all these companies that I know are fundamentally good. And why in my taxable brokerage account that's not on my Roth, I have ETFs. Why is this? Because think of the Warren Buffetts, think of the Bill Ackman, the best investors of all time, and I'll use it for one of my examples. One of my favorite YouTubers, Joseph Carlson. He makes videos all the time on his own stock portfolio. Does he hold the same companies forever? No, he doesn't. He tries, he makes videos, oh, I'm gonna hold the stock forever, but eventually even guys like Warren Buffett, they don't hold the same stock forever. Sometimes they sell out of the company, sometimes they change their holdings around, sometimes a new company they want, and when you sell these old companies, you get taxed in a regular brokerage account. That's why the Roth IRA, even though it's a retirement account, you can use it, take advantage of this by holding single stocks or more risky assets that you can sell out of whenever you want without tax implications. That's why when I open my regular taxable brokerage account, I put strictly VU or SPLG, S&P 500, the top indexes, and a growth ETF like the NASDAQ 100 top technology sectors, or a growth ETF. Why? Because these are a big ETF basket that's diversified, and I will never sell these. I will never sell these because a company does bad, or or fundamental, or there's a stock crash and maybe it goes to zero. You know why? Because I don't pick the stocks that are in there. There's hundreds and hundreds of stocks in there. So basically, if you're wondering what I told you, we're gonna get into the companies perfectly. Roth IRA, we started here. There's a couple ways you can go for Roth IRA. Number 1, you could go with the reputable companies. There's about 3 companies I'd recommend. 2, I'm gonna start off. This is for the beginner investors here. Very simple to use websites. They're very simple to use websites. There's one caveat with these established firms, that their websites are a little bit on the older side. They're not new, they're not fresh. So for people that use Instagram, people that use YouTube all the time, you may not be able to see these in the light that an older person would, because it's more toned for the older side. Those 2 accounts, those 2 companies, Charles Schwab and Fidelity, perfect for investors. I personally use Charles Schwab, but Fidelity is a tiny bit better, and they have millions of customers. Number 2, the second reputable company, this is Vanguard. They're more focused on the more of the experts, or more of the influenced, or the more of experienced investors. So if you invested before, you know what you're doing, Vanguard is better because they have less beginner resources and more research tools. So they're more research oriented into the market, which is why I recommend these 3 companies, because these are companies that have been around for a while. People trust them. I trust them. The second way you can go is into a mobile app. Like I said, a lot of people watching my videos are probably young, under 18, 20s, 30s. So they're going to want a fresh mobile app. Another caveat with the reliable companies. They don't have great mobile apps. Fidelity does, but Charles Schwab's mobile app has a 2.3 stars out of 5. People have problems with it all the time. It's a huge company, a lot of people on the app. So if you want a mobile app and you want a simple investing firm, there's like Webull, there's Moomoo, and my favorite, there is Robinhood, which make it super easy for you to invest. So another reason why you would want to choose one of these mobile app or newer companies is because of what they offer. These big companies, these big reliable companies, they don't have starting bonuses like a credit card. So for Robinhood, if you sign up or Moomoo, they can give you $200, $300 in free stocks. Cool. And also Robinhood, they have promotions running, like if you transfer your IRA in them, they'll give you 1% extra, or if you pay for their subscription, $5 a month, they'll give you 3% match. So there's things like that. The mobile app is really easy to use. It's really easy to use for options and crypto, whatever you want to use, because young people into that stuff. But that's why I'm getting the caveat with your Roth IRA. If you're really into options, if you're really into short-term trading, you can do it in your Roth too, because in short-term capital gains with your taxable accounts, you'll be paying 30, 40%, 50% on your capital gains tax and income tax, which is why you need to have a Roth IRA and a taxable brokerage account. Taxable brokerage account, strictly ETFs. Your Roth, you can do ETFs, that's probably the best way, but if you want stocks, you want crypto, put it in your Roth, your options trader in your Roth. Now, number 2, taxable account. What should be used? Well, the same companies, Charles Schwab, Fidelity, Vanguard, Robinhood, Moomoo, those are all good. You either go with the reliable or you go with the new mobile apps. It's whatever you want. But like I said, I was gonna say what type of assets to put in them. You're taxable, just go strictly ETFs. I don't care if you're a stock investor, it will outperform your stocks. Even if you're the best stock picker ever, it will outperform because of the buying and selling you would probably have to do if one of your fundamentals of the company go down. That's why in your Roth IRA, you don't have to worry about that because you can buy or sell whenever. I find myself selling out of companies all the time because the individual stocks at home, I own 34 individual stocks. So that's why I love my Roth IRA so much. But also in my taxable account, we have that. So you have your taxable account, so you're wondering how is this in the long term? We have to take out capital gains tax in the long term and pay 30 to 40% and income tax on it. Why should we even hold in the first place? Well, ladies and gentlemen, you don't pay tax on everything. You only pay tax on your capital gains, which is good. So if you put money in there, you can take out what you put in without paying any tax on it. It's only the capital gains tax and the income tax we're focusing on. But there's even a way to avoid that, guys. So what's the next account? 401k. This is a little bit different. You don't do the investing yourself. It's your company. What type of people should hold a 401k? It's if you're a full-time worker or you plan to stay at your job for the next 1 to 2 years. Why do I say that? Because it's a hassle, a pain to transfer over your 401k and roll over into your next company. But if you don't mind the hassle, it's totally worth it. Even if you're just having a job and you want to get into, ask your employer, oh, the 401k. So why is the 401k different? It's not, that doesn't have as much tax advantage as the Roth. Isn't this like a regular taxable account? Well, no, it's not regular taxable because there is benefits. Like your employer could potentially match up to 3 to 8% of your investments, of your money put in there for free. Why? Because they want you to put your money in because the government incentivizes them through grants for you to save up for retirement. For example, if I could put $100 inside my 401k, then I would get like $3 or $8 back. But if you keep putting money in there, then it'll grow up over time. And this is the closest thing you'll ever get to free money. And one thing I forgot to mention about some of the Roth IRAs is that, like Robinhood Gold, if you pay just $5 a month, you can get 3% free. You can get 3% free on the money you contribute in there. That's why I said if you want these newer or these less reliable companies, these less mega companies, then you will get better rewards in return just because they're looking for more customers all the time, while these companies like Charles Schwab and Fidelity don't need these companies all the time. Next, we're getting back in the 401k. So you get your 3 to 8% match. Well, there's more. Sometimes companies offer these matches at a higher percentage for their own company shares. So of course, you know how one of the reasons the stock could potentially go up is people buy into the shares. So when you put money into your Roth IRA and when you put money into your 401k, a potential caveat of your company is they could give you company stock for instead of a 3 match, they can give you a higher percentage match just because you're buying their company shares. And that's free money. You can sell it off right away if you wanted to, but that's only potentially. A 401k, how it works, it's not a regular investing account. They automatically put your money into a fund. The bad thing about these funds, they have extremely high expense ratios in the mutual funds. They're actively managed, which actively managed funds, if you didn't know, are going to do the same or underperform the market with extremely high expense ratios and cost you thousands of dollars over the long run. Just quick, they put it in there. Your 401k has a $23.5 thousand limit per year just because of this match. They won't want everybody taking advantage of this, similar to a Roth, but it's still more than a Roth because a Roth is more powerful and as a 100% tax advantage. Well, this is less tax advantage, but you still can take advantage of this, guys. So, getting back into a 401k. So we got 3% match, we got the company stock, all in here. Next account we're gonna get into. Next account is a high yield savings account. What is a high yield savings account? Well, you know your regular banking account, you have a regular checking account, savings account. At a huge firm, you're gonna get 0.3, 0.1 interest. No, at another account, if you use a high yield savings account, you're gonna get a lot more interest, up to 4 to 5%. 5.5 is the highest I've seen. So you may be one of those people that I've seen looking at T-bills or CDs. Those are good investments. The thing is, your investments are locked up. You cannot remove them sending with stocks. They're locked up in the stocks, and you don't want to sell stocks, especially if you have a regular account and you have a taxable event. But where do you hold your excess funds? It's called an emergency fund. You can't put all of your money in the stock market at once, because if you know, 35% of Americans cannot afford a $1,000 expense if something bad happens. Like, for example, my car has been breakdown like crazy. We paid $5K for it, and now we're paying over $6K in just to fix it, because there's been these unexpected caveats that have happened to the car that cost us to take money out of our own pocket and put it on there. And if we didn't have our own source of emergency fund, we wouldn't be able to pay for that. So why should we focus on this? Because 4 to 5% isn't bad. That's good. Sometimes the market doesn't always go up. There's been years, 6 years in the time period where the S&P 500 goes down 5 years in a row. So if you would have kept the money in a high yield, you would have actually made more money than the market just by holding it in there. And it's perfectly safe. You have zero risk on it, and you always need money in the bank somewhere. So instead of having money in a savings account, take it out, plop it, especially don't have it in a checking account. Only have enough in your checking account for you to pay off your bills every year. So take that money, extra money out. It's supposed to be 3 to 6 months of expenses. If you don't know, you want to calculate your expenses, a good thing is $5,000 to $6,000. I know it's a lot, but you can put money in there over time to build an emergency fund, and just sits in there and it grows and grows and grows and grows. And you can take it out whenever you want. That's another thing. It's liquid. You can take it out whenever you want. Just make sure you look for the right account. High yield savings account. What are the accounts, guys? So there's a couple ways you can go. You can go with a safe, reliable company. That's FDIC insured. What is FDIC insured? It's the government backing you up to $25,000 and $2,500,000 in your account in case the bank goes bankrupt, and they'll be able to pay you out. So what's the reputable companies? These reputable companies have a safe amount. So high yield savings accounts are affected a lot by bonds and interest rates. So when the interest rates goes up or down, it can affect how the company changes the rate of the high yield savings account. But by putting your money in these reputable companies, you can know exactly what to expect when the inflation or when the interest rates, or when the federal chairperson Jerome Powell changes the interest rates. You know exactly what to expect. Like, for example, Barclays, a very reputable company. You can hold your online savings account on there. So if you, right now it's at 3.9, which is good. The maximum is 4.1. I will get into why we don't want the 4.1 right now. We want 3.9 and Barclays. So, but when we look in the past, when the rates were higher or lower, it was at 5.5. But now we have, in the other account, we have the newer companies that offer the high yields. It's the one, like I said, with the 4.1. Why are we taking 3.9 instead of 4.1? Well, these are newer companies. These banks need people in their companies. They need people to put their money in there. So we have caveats. They'll start at extremely high rates that can't be matched or can't be profited from. And once people put all their money in, they search up highest high yield savings accounts. Boom, right there, 4.1. Put it all in. Well, next thing you know, drops 3.9. It's fine. People don't bother. But then it's 3.8, 3.7. And then all of a sudden, it's underneath something like Barclays. And now the people will just they don't want to change their money, so they'll stay in there. That's why we don't want these new companies. That's why reputable companies. There's a second option, though, I would recommend. 2 more options. The online bank account, similar to the new banks. It's online like SoFi, but they're more reputable. Since they're online bank, they'll give you a higher yield than a mega bank. So it will also match the 3.9 of Barclays. But the thing is, It's strictly online. So next, the last thing you can do is the mega banks. So I told you to stay away from the mega banks, the American Expresses, the Wells Fargo, because they give terrible rates. Well, there's some mega banks that have followed suit with these smaller companies. Like example, Capital One gives 3.6. Well, 3.6 isn't in a 3.9. Why would I want to go with Capital One? Well, because these mega banks, you may already have your money in these mega banks or have like a credit card or a checking account with them. So for you, it'll be a lot easier for you to open high yield savings in Capital One, or for example, any other mega bank you may be holding that does offer a high yield savings account. So I would advise you, if you're holding your money in any of these well-known banks, to see if they all have high yield savings account options, because for you it might be better understandable for you to put your money in something that you trust in, or something that you use, instead of opening a different bank account and have all these different bank accounts. But for me, I personally am going to open one with Barclays in the next week here, and I like 3.9, and Barclays has been a very established company, which is the one I'm going to be choosing. So lastly, I told you that we're getting into another one that nobody's heard about. It's called a HSA. You probably have no idea what a HSA is. That is a health savings account. Put it right here. Power of editing. Boom. HSA, health savings account. What is a health savings account? Well, it works the same as a regular investment account. But, so you know insurance, right? Well, if you were a little kid and you don't know what insurance is, insurance doesn't pay for everything all the time. There's different levels and premiums for insurance. So for example, if you work as a police officer and you can already have insurance, they'll pay for your insurance, but that insurance won't pay for everything. Or if your job doesn't offer good insurance, you want to have your own insurance, you buy a certain level of gold, premium, silver, different high levels of insurance, and the more you pay, the more it covers. Well, what happens if your insurance doesn't pay for all your medical bills? Well, this is where HSA comes in. It's tax-free. It's a tax-free. There's a limit. I have to look into that. You can do that in your own research, guys, because I did this on the fly. But the HSA, it's a tax-free investment account, which lets you invest in anything you want. So you can put in index funds, you can put in your own stocks, you can put in crypto, you can do whatever you want with it. And you can take it out tax-free for qualified medical expenses. Why do we need this account? Because why would we only want to take out money for qualified medical expenses? Similar to why we have the high yield savings account for emergencies. And this is being able to take advantage of all the tax-free savings we can possibly in our entire lives. So if there's a tax-free opportunity out there, of course, we are gonna take it. Another thing, I'll get into the caveats right now. Roth IRA, there's other qualified expenses that you can take out money for. Like you can take out the contributions. So let's say you put in 30 years, if I put in $7,000, I'll have put in $217,000 in contributions, and my original contribution at 10% rate will be at $1.3 million. So, and what happens if I'm not 50? So in 30 years, I will not be 59 and a half yet. So how I plan on taking out that money? So I went to another video on my Roth IRA plan. You can watch that. I'll link the video down below. But with this plan, what you can do is you can take out your contributions. So the whole entire $217,000 I put in, I can take that out tax-free, whatever. I can take that before 59.5, because if you try to take out the capital gain, you try to take out your gains, and you have to pay a 10% fee plus capital gains and income tax. We don't want that. That would be like 50% tax. Might as well wait for 59.5 for the rest of the money to come out. But I'm just telling you this just so you know that these accounts do have caveats, but you can get around them easy, just like a backdoor Roth. If you see the income limit, just like everything else. So these 5 accounts have everything you need. Your emergency fund, boom. Take your money out of savings account, put in a high yield, boom. You have your next step, Roth IRA. Take advantage of tax-free savings. Do your stocks, do your fund things, do your ETFs. Boom. Next, you max out your Roth. What else do you want? You have your employer. You want 3 to 8% match. Boom, free money. Next, you max all those out. Next, you want your brokerage account, but you don't want to pay capital gains tax or income tax. You don't want to move your stuff around. You just want something you can invest in passively, not worry about. ETFs, one growth, one dividend, or one based on the S&P. Lastly, once you have everything else, you want to make sure you're ultra safe. So your HSA, and you have your health savings account. You put your tax-free money in there. You break it around whatever you have, something medical expenses. You go to your tax guy. He says, "Yeah, we can do that for you." Boom. You have all of that. Last thing, is there anything else that I can possibly tell you? Yes, there is. There's another thing. If you have children, which I don't know if you do if you watch this, you can open a qualified investment account just for them, and it's for qualified colleges and educational expenses, just like your HSA, just like your Roth IRA. It's tax free. So we have 3 tax-free accounts that completely pay 0 expenses on. So what do you do after you have all of that settled in? Well, There's other things you can do, like invest in real estate. If you get to do all of these, you probably are pretty done well in life. You can probably treat yourself to something nice, go on vacation, buy something. Of course, the number one way to save money is to don't let lifestyle inflation get up to you. What is lifestyle inflation? Do not let the expenses around you, don't let, because you make more money or have this wealth, this could be only better things, because and at the end, material things won't fill your heart. Only real things, real love, real religion, anything that's real in relationships in your life, giving back, that will fill your heart with it. So just because you have this money doesn't mean you should do the lifestyle inflation. But another caveat, just because you don't want to have lifestyle inflation doesn't mean you can't spend a little bit of money. You have the money and you have the right to spend it, guys. So I'm Josh Engel, and of course, those are my top four accounts, technically 2 more, that we have gotten into. And have a nice day, guys.